You are told the smartest people never make the same mistake. They do. They just make it bigger. Right now, a handful of hedge funds are running a single trade with borrowed money. They buy U.S. Treasury bonds. Then they sell futures on those same bonds and pocket the sliver of a price gap between them. The gap is almost nothing, a rounding error. So they use borrowed money to turn nothing into something. That one trade is now worth around $1 trillion. And in 2026, the regulators, who watch the system for a living, have started attaching an ugly word to it. Systemic. It feels new. It is not. This already happened. In 1998, the smartest men on Wall Street built the same machine. Two of them had just won the Nobel Prize in economics. For 3 years, it looked like pure genius. Then it lost $4.5 billion in 4 months, and the Federal Reserve had to pull 14 banks into a room to keep it from breaking the world. Their names read like a dream team. The fund was Long-Term Capital Management, founded in 1994 by John Meriwether, a near-mythical bond trader who had run the money machine at Salomon Brothers. Meriwether did not hire salesmen. He hired the people who had written the actual mathematics of modern finance. Myron Scholes and Robert Merton, whose model for pricing options would earn them the Nobel Prize in 1997, sat on his board. So did a former vice chairman of the Federal Reserve. This was not a room of gamblers. It may have been the greatest concentration of financial brainpower ever assembled. And their idea was not reckless, just the opposite. LTCM specialized in something called convergence arbitrage. Strip out the jargon and it is simple. They looked for two things that should cost the same but, for a moment, didn't. A brand new Treasury bond and a nearly identical older one. History said those little gaps almost always closed in time, so the fund bet they would close, quietly, patiently, across thousands of positions at once. Each individual bet was tiny. Each one, on its own, was almost boringly safe. There was just one problem with getting rich off gaps that small. The gaps are small. To turn a rounding error into a fortune, you need size. And size means borrowing, so LTCM borrowed. By the start of 1998, the fund had roughly $5 billion of its own money and had borrowed more than $120 billion on top of it. That is leverage of about 25 to 1. For every dollar that was theirs, another 24 were borrowed, and that was before the derivatives. Off the balance sheet, LTCM held contracts with a notional value of around $1.25 trillion, a measure of how much of the market they were touching. There is an old phrase for this: picking up nickels in front of a steamroller. For a while, the nickels were wonderful. After fees, the fund returned around 40% a year in 1995 and 1996. Investors pleaded to get in. Banks competed to lend to it, on terms they offered almost no one else, because who would not want to be in business with two Nobel laureates? By 1997, it was so flush it handed money back to investors. It could not find enough gaps to fill. Then, in the summer of 1998, the world stopped cooperating. On August 17th, Russia defaulted on its own debt. A government simply declined to pay, the kind of event the models treated as unthinkable. And it set off the one thing arbitrage cannot survive: panic. Frightened investors dumped anything risky and ran for the safest, most liquid assets on Earth. Every gap LTCM had bet would narrow, instead ripped wider, all at once, in every market, on the same day. Now here is the piece that turns a bad month into a catastrophe. LTCM's models assumed its thousands of bets were largely independent, that they would not all fail together. In a genuine panic, that assumption dies. The single risk the fund had engineered around was the only risk that ended up mattering, and at 25 to 1, they did not have to be very wrong. A move of less than 4% against them was enough to erase every dollar of their own capital. The losses came fast, and they fed on themselves. Leverage does not just multiply your gains, it sets a clock. Every daily loss triggered margin calls, lenders demanding more cash immediately. To raise it, LTCM had to sell into a market already in free fall, which pushed prices further against its own book, triggering the next round of calls. Sell, drop, sell, drop. In roughly 4 months, the fund lost about $4.5 billion, nearly everything it had. In today's money, adjusting for inflation, that is around $9.5 billion, gone in a single season. And this is the cruelest part. They were not even wrong. Given enough time, most of those gaps did converge. Exactly as the models predicted. A fund that could have simply held on would have collected. But leverage does not let you hold on. It forces you to be solvent every single day, whether or not you are right in the end. There's a line usually put in John Maynard Keynes's mouth, though no one can prove he said it. The market can stay irrational longer than you can stay solvent. LTCM was the proof. Being right was not enough. You had to survive to collect. By late September, the fund was days from collapse, and that is when it stopped being one firm's problem. Because remember the banks that had competed to lend? They were now the counterparties on that trillion-dollar book. If LTCM failed and dumped all of it onto a terrified market in a fire sale, the damage would rip straight through the biggest names on Wall Street. LTCM was not too big to fail, it was too connected to fail. So on September 22nd, the president of the Federal Reserve Bank of New York, William McDonough, summoned the heads of Wall Street into a single room. Now look at what is keeping regulators awake in 2026. It is called the basis trade, and it is convergence arbitrage in new clothes. Buy the Treasury bond, sell the future, harvest the gap that history says will close. Each trade is tiny, each looks safe. So to make it worth doing, hedge funds run it with enormous leverage, this time borrowed through the repo market at ratios that would make 1998 look cautious. The trade has swollen to roughly $1 trillion, sitting inside the $31 trillion market for U.S. government debt, the bedrock the entire financial system is priced against. And the fear is almost word for word the same. That some shock forces a sudden unwind, that the funds are made to sell everything at once, that the fire sale freezes the one market that is never allowed to freeze. The Financial Stability Board has warned about it. Fed officials have warned about it. Some are quietly asking whether the central bank should keep a facility standing by to step in, a very polite way of asking who catches it next time. But a rhyme is not a prophecy, and honesty means marking where it breaks. LTCM was a single fund with a concentrated, exotic book and dangerously little room for error. The modern basis trade is spread across many firms. It lives in the most liquid market on the planet, and regulators are watching it in broad daylight. In large part because 1998 taught them to. After LTCM and again after 2008, overseers built guardrails that did not exist back then. Margin rules, stress tests, disclosure. The machine is far bigger today, but the people around it are no longer being surprised by the basic shape of the danger. And one thing about 1998 genuinely broke the pattern. When McDonough got the banks in that room, the Fed did not spend a single dollar of public money. It organized the people who stood to lose the most and made them fund the rescue themselves, about $3.5 billion from the 14 firms, in exchange for taking over the fund and unwinding it slowly. No taxpayer check, just a referee, making sure the fire was smothered before it spread. Whether the next unwind can be contained that cleanly is the open question. So the next time you hear that this time is different, that the math is sharper, the models wiser, the people brighter, picture the firm that had 2 Nobel laureates, a former Fed official, and the safest-looking trade on Wall Street. They were not careless. They were not stupid. By every measure anyone could name, they were too smart to fail. That was the problem. History doesn't repeat, but it rhymes. And this particular rhyme is still out there, still borrowing. None of this is investment advice. It is just the pattern, so you can recognize it when it visits again.